Hey everybody, Brian Shannon here from alphatrends.net. It is Friday the 14th of October, and it was a pretty tough week for equities overall. The S&P lost about a percentage point. Semiconductors finally gave back some ground. We saw last week they were up over 30% for the year, but dropped about 3% this week. And those biotechs just continue to be the dogs. And let's take a look at the charts here. I was out for most of the week, and I think that was a good thing. But the S&P 500 once again found resistance on Monday at that declining 50-day moving average, and where we ended up for the week as well was pretty much we found resistance today near the open at the volume weighted average price since Brexit, and the volume weighted average price since this gap lower you can see is also coming together to kind of formulate some resistance in here. So I think going into next week with a market below a declining 10, 20, and 50-day moving average on the S&P 500, you could say that things have certainly changed from a near-term perspective. And if we can't get back above and hold above 215 or so, then this market has the chance of a deeper pullback. All week though, I mean, besides Monday's gap higher, we've been below a declining 5-day moving average, and that told us not to trust any rally attempts in here. In order again for this market to become more neutral in the intermediate term, we're going to need to see it hold above this circled area 214.50 to 215. If it can do that, then the recovery from this pullback begins, and perhaps we suck in more shorts. But something, as I was mentioning to subscribers this week, is we always have to be aware of where has a market come from before we decide to get involved in a so-called breakout or breakdown. When a market goes from, as it did here, 212.5 up to 217.5, buying that so-called breakout, it's already expended a lot of energy getting there. And then this week we saw that sellers showed up once again at the declining 50-day moving average. And for the people who sell short, after a decline like that, typically are going to undergo some difficult period for at least the intermediate term before they're proven right, or worse, they're going to get stopped out before their trade comes to fruition. So again, going into next week, I think that for now, it's likely that we're going to find resistance in this area. And as far as this week's activity goes, let's take a look at a 15-minute chart. You can see here's the week-to-date volume-weighted average price. The market tried to get above it today, but couldn't sustain, and we closed below that week-to-date volume-weighted average price. The two-day volume-weighted average price, that's kind of an important level, I think, because it shows, the flush-out low here, and I think breaking back probably below 212.75 and then holding below that level for more than a half hour or so would likely set up further downside from here. And again, we are also stuck below the volume-weighted average price from Brexit. The bigger picture, we could take a look the volume weighted average price from the low in February, and you can see that kind of ties in along with that 200-day moving average down in here, and the year-to-date volume weighted average price is down a little bit lower at about 205. I think that's too far away for now to be anything that we're going to consider, but you look at the trend line, and it's good to see that at least on a closing basis we did hold above that. We're just in a very indecisive period because again, that weekly chart, when we back it up, this is where that prior resistance is now trying to hold a support. So when you look at all those different time frames together, it creates a very clear picture, and the clarity is we are uncertain what is next here, so we have to take things slow. That's what's clear. It's clear that we have a heightened sense of uncertainty right now, and making big bets, especially going into earnings season, coming up, it's going to be a case-by-case basis for individual stocks, and expect some to soar on earnings and expect others to just absolutely implode. The Nasdaq for the week lost a little bit of ground, as we noted, and this was a case of it got out to a new all-time high here, and then from that failed breakout came a fast move lower here. That's kind of the second time that it's done that, where it broke out and then pulled back quickly. Last time it recovered. This time it's not doing that. This is the first close below the 50-day moving average since back in September, and only the second close below it since since Brexit. As far as the volume weighted average price from Brexit goes, you can see that's down near 115, so a little bit further away. But if you take it since this gap lower over here, we can see that we're struggling with that volume weighted average price in the Nasdaq as well. And then, of course, if we just take a look at traditional horizontal sideways, support and resistance, this prior support area is now going likely to become resistance. We're going to need to see, and even when it gets above it, here's the main point I was trying to make. Even when it gets above this prior band of support, you can't trust it with a declining 5-day moving average. Go back and listen to my videos for the last 100 years. I've been saying the same exact thing, that we cannot trust rallies with a declining 5-day moving average. They're fine for day trades and shorter term trades. And, for instance, if you had purchased yesterday, let's say, as it got back above yesterday's volume weighted average price and made a higher high above that right here, then, holding a little overnight, that's not a horrible idea, but still, it is less likely to continue the upside. So if you get an entry like that, it's best, I think, to sell at least half of it on strength, and then set your new stop based on whatever like today's action might be with the with the gap higher, and then as it broke below the volume weighted average price, that's where the buyers took and maintained control of the market for the day. So heading into Monday, I think back below 117. 116.75 to 117. We stay below that for more than a half hour or so, then this market has a bigger likelihood of continuing down lower and perhaps down as low as that 115 level. The Russell 2000 was notably weaker here, as again it lost 3% for the week. Now, year to date it's done better than the S&P and the Nasdaq, but with it up close to 7%. But it lost a lot of ground on a relative strength basis this week, and it's once again testing this area, this whole band of prior support. This has been an important level in here, just around that 120 level. The thing is, if it breaks below 120, let's say on Monday, does that look like a good short sale after it's just dropped from 125? In my mind, the answer is no, it doesn't look like it. I would prefer that if it was to break down below that it then rally back up, create a lower high, find some resistance in this general area where we've seen some consolidation, and then to short it on the way back down over here. That way we would not only have a better entry, but we would have a logical place to put our stop just above whatever this lower high might end up being. Now, I realize I just made up a complete scenario, but you have to look at what's most likely. We have to anticipate all potential scenarios and then wait patiently in cash, and then once we get our signal that we're looking for, then we participate and manage risk and listen to the message of the market from there. So drilling down to a shorter term time frame in the Russell 2000, let's just clear that all off. One thing is very clear. We're below a declining 5-day moving average. The Russell 2000, the bullish case this week would have been to come up to this level, back off a little bit, and then try to build a higher low, and then from there, this type of breakout right here could have been bought because we'd have a stop at this level. If you bought a breakout here, a stop where? Down below this, it just doesn't make sense from a risk reward standpoint. So that's kind of the same thing upside down. But the Russell 2000 is vulnerable here to further selling. We do have an area that has been important from a bigger time frame, so let's not get too bearish, especially after it's broken down. Perhaps we're gonna again, make another attempted bounce in here first, and then break down. So something more like along the lines of this is more likely, and what would be a better scenario for getting short, if that's the way you're looking at this market. Now, from the low for the year, the volume weighted average price way down under 115 from the Brexit low. You can see that we are trying to hold that area right now, and rightfully so. That's where the majority of the trading has been. So that should be where the most volume has taken place on average. Semiconductors, as we know, have had a strong year, and this rally has been very strong since Brexit. But we have like any level of support, the more times it's tested, the more likely it is to fail to hold. This is the second time since this summer that we've come down and tested the 50-day moving average, and at least initially found some support. But when we drill down to a 30-minute time frame, we see This time, right now at least, we're stuck under the declining 5-day moving average. So that makes it more vulnerable. And I think that in order for us to be convinced the buyers are back in control again, we need this market back above and holding above 68.50. I think that you could make a case that it could do that. Certainly the primary trend is still higher. It's definitely extended. It's been extended for a while. That's not news. We've known that. But we're finding support in this prior area that was resistance and then support again in the 50-day moving average. So we have to just listen to the market and let it give us more information before we can take a stand and say, here's where I want to be short. And I think that, it's probably the VWAP from this low at least and this little consolidation back below 67 would most likely bring us down through this little area of support and then perhaps down towards the 65 level. So I'd be alert for that. If you've been riding this market long, then it's been a great ride. Have a strategy for locking in your profits. Know your time frame. As always, one person's trade is going to be different than the next one because time commitments, risk tolerance, how much money is in your account and how many trades you can make. But the biotechs, as I've been saying, they've been in a stage 4 downtrend, and this was the stage 1 accumulation. The market had the opportunity to, and what we were looking for the potential long side was to pull back down in here, find support, and then create what we were looking at was the potential for this being a left shoulder, this being a head, and this being a right shoulder. We don't buy pullbacks to moving averages. We look at the pullbacks and say, is there evidence in this area that the buyers are in fact gaining control? Well, what do we see there? Do we see a higher high and a higher low above a rising 5-day moving average? Absolutely not. The direction of the 5-day moving average was lower in here. We spoke about the potential for a bullish reversal, that it would have looked like this, that if it came down, found support near that 5-day moving average, the 5-day moving average flattens out, and then to buy it above this level here, which was of course prior support in this area. So we had this prior support back in later September rather, late September support turned into resistance. And if it had come up and then broken through that, well, at that point, we would have wanted to purchase here with a stop underneath this level. Instead, we saw the market continue to go lower, and you can look at potential scenarios and say, here's what it takes to get me bullish. But if that never happens, the scenario, well, then you never put your money at risk, and it's just the market didn't agree with what you thought the potential was, and we're back to now on the weekly time frame. We're back into this sideways range, and as the saying goes, if they don't scare you out on these initial waves lower, they will often wear you out. What's most likely going to have to occur for the biotechs to once again be a good longer term buy is this 200-day moving average is going to need to flatten out, and then we can have confirmation once it does this and gets a higher high above that 200-day moving average. It's no different than I mentioned on Twitter that I had spoken to my mom the other day, and she said, Brian, what should I do with this stock? You told me to buy it back in here, and it was at $39.90. It was just breaking out. I'd done a blog post on it right in this area right here. It was just under $40. It was paying a 5% dividend at the time. Now the current dividend is 2.5%. She has her 5% locked in from over there, so she's been getting 4.9% now for 4 years. So about a 20% cash return, and now she can, if she cashes out, it's a long-term capital gain and doubled her money. I told her to put her stop underneath this level here, but the point I was trying to make was, if you look at how this stock became a buy once again, it was once it had recaptured and made that higher high in this area above the longer term moving averages that were all rising. It broke out, it tested it, then it began its move higher once again, and that was the proper place. That's where I had her buy. Yes, you could have made more money if you bought down in here, but you're buying in all this uncertainty, and you're seeing the stock go sideways for years rather than doing what we want a stock to do, which is to go higher and give us capital gains. Apple this week, we saw a nice move beyond that level of resistance that we had spoken spoken about. We talked about if it could get back up above this level, then the buyers would once again regain control because it was back above the volume weighted average price from this level, and that we had seen the pressure building with these higher lows and that area of resistance and these lower highs. So once it broke beyond that resistance, buyers regained control. It pulled back to the rising 5-day moving average. And again, the buyers are still in control here on the intermediate term. They're in control on the daily time frame where we see a rising 10, 20, and 50-day moving average. And on the longer term time frame, we see in Apple that we have a rising 10, 20, 30, and 40-week moving average. To me, this area right in here is similar to Lilly. It doesn't mean it's going to double the way Lilly did, but it means here's the time to buy because the trends are aligned. And now we have, for an investor, I think, your stop goes underneath this pullback low, but some people would have their stop under here. The point is, on all time frames, Apple, the buyers are in control, and it looks like a good, candidate for upside continuation. The bonds got hit a little further this week. They are not finding support near that 200-day moving average, which we know is also approximately the year-to-date volume-weighted average price we had pointed out last week. But the 5-day moving average, we got above it this week. But what was the direction of the 5-day moving average? What we want to see before we decide to buy is we want to see the 5-day moving average flatten out, and then we want to see a higher high above that flat to rising 5-day moving average, and then our stop would go underneath the most recent relevant higher low. So while it may, most people I'm not going to short right in here. I'm going to instead wait to see if it stabilizes. If you do short, it happened to work this time. But after a drop of 139 down to 133, I thought maybe it was going to do something more like this and then be able to get moving higher. But again, if you don't have a position, it doesn't hurt you. There's no harm in that. Expedia broke out. We spoke about that last week. That was my best trade of the week. And that's it for today. Thanks for tuning in. I will be back again next week.